Alright, hi there, welcome back to another video. This time we are going to comment on a couple of general market topics. Like for example, Mark Zuckerberg is in full war mode when it comes to the battle between the Quest 3 and the Apple Vision Pro. Then we are going to discuss some of the recently revealed 13F filings of famous superstar investors. We'll take a look at Warren Buffett's portfolio activity, which stocks he has sold and bought, whether we have learned something new about his so-called mystery stock. We will also talk about interest rates and their impact on stocks returns in 2024. And finally, we'll discuss a prediction that a fund manager made that the Nasdaq will double over the next 2 to 3 years. So without further ado, let's get started. Alright, so we are going to start with Mark Zuckerberg because he has recently published a video on his Instagram profile in which he reviewed the Apple Vision Pro and compared it to the Quest 3. And this video, for some reason, got a lot of media attention because Zuckerberg essentially said that the Quest 3 is by far the superior product, even though it is significantly cheaper. And I will show you some sequences from that clip in just a second, but effectively, Zuckerberg was outlining that the Quest 3 is 7 times less expensive, but yet more comfortable. He argued that the Quest 3 is the better product when it comes to gaming and watching videos on YouTube. And basically he concluded that he himself is surprised that the Quest 3 is not only providing the better value, i.e. the quality you get for the price you pay, but also generally, regardless of price, the better product. And as I said, I'll show you a little sequence from that video right now. But while you watch it, maybe you can let me know in the comments down below whether you agree with Zuckerberg or not.
So I finally tried Apple's Vision Pro. And, I have to say that before this, I expected that Quest would be the better value for most people since it's really good and it's like 7 times less expensive. But after using it, I don't just think that Quest is the better value. I think that Quest is the better product, period. And, the different companies made different design decisions for the headsets. They have different strengths. But overall, Quest is better for the vast majority of things that people use mixed reality for. Now, my friend Kenny is actually capturing this video on Quest's high-resolution mixed reality pass-through right now. We're just here in my living room, and you can see his browser windows and whatever else he's got running up here. So yeah, Quest 3 does high-quality pass-through with big screens, just like Vision Pro. But we also designed it to be great for a lot of other things, moving around, playing games, hanging out with friends and socializing, working out, and more. Quest, I think is just a lot more comfortable. We designed it to weigh 120 grams less, which makes a really big difference on your face. There's no wires that get in the way when you move around. It's a big deal. Our field of view is wider, and I found our screen to be brighter also. I also noticed that Apple's headset has this motion blur as you move around, which Quest is just a lot crisper. Now, Apple's screen does have a higher resolution, and that's really nice. But I was surprised by how many trade-offs they had to make to the quality of the device and the comfort and ergonomics and other aspects of the display and artifacts in order to get to that. Now, for input, Quest supports precision controllers that are great for games. Both headsets support hand tracking, but I found ours to be a little more accurate. Apple's eye tracking is really nice. We actually had those sensors back in Quest Pro. We took them out for Quest 3, and we're going to bring them back in the future. It's a nice interface. It's not perfect for everything, though. For typing or complex tasks, you're going to want things like hands or a keyboard or controllers or eventually a neural interface for those kind of inputs.
Okay, let me add some more commentary here. So first of all, I think this video is fantastic. It's like very real, very authentic. There's not a lot of editing going on. It's basically recorded in one take. The whole setup doesn't look very professional. It's just in Mark Zuckerberg's living room, I think. Or at least that's what it feels like. Zuckerberg is in some way praising the strength of his competitor, Apple. And basically, he's just like a tech reviewer talking about the strengths and weaknesses of both systems. And I think you can really feel the enthusiasm that Zuckerberg has for this product. And I think that's amazing. That's something only a founder CEO can do, which is why I'm super happy that I'm partnering with Zuckerberg by owning Meta stock. I don't see any of the other tech CEOs, be it Tim Cook or Nadella at Microsoft or Sundar Pichai at Google, recording a similar video, basically going in full attack mode on some of their competitors. Just imagine Sundar Pichai recording a similar video in which he's bashing OpenAI's ChatGPT. And you can really tell that Zuckerberg knows the product very well, probably knows the product better than many other CEOs know the product of their companies. And I think just putting a video like this out there takes a lot of courage. Now, to be fair, you could certainly argue that Zuckerberg is certainly the wrong guy to give you an unbiased review here. So I guess everything he's saying in this video should be taken with a grain of salt. So you might want to, in addition to this short review by Zuckerberg, take into account other third-party independent reviews. And to be fair, the reviews of other more independent reviewers seem to be much more favorable in terms of what Apple has actually created here. Okay, and with that being said, let's take a look at the next chapter of this video. We will take a look at the 13 Fs that were revealed over the last couple of days. And we'll start with Buffett. So I'm just going to show you the overview of Warren Buffett's activity at Berkshire Hathaway on screen right now. And basically, Warren Buffett increased his stake in 3 stocks, he exited 4 positions and kept at least 1 holding confidential by making use of some SEC regulations. Okay, if we take a look at Warren Buffett's portfolio here, I think the headline news is that he, for the first time in a long time, decreased his position in Apple by around 1%. But despite that, because of Apple's good stock performance, Apple still represents around 50% of Berkshire's equity portfolio. Then Buffett increased his position in Chevron by around 14%. He slashed his position by 32% in Paramount Global. Similarly, he also decreased his position in HP by 78%. And he almost quadrupled his position in SiriusXM Holdings. So everyone was awaiting whether we will finally learn which mystery stock Buffett has been building over, I think, the last 2 or 3 quarters, which he hasn't revealed yet because he agreed with the SEC to keep this stake confidential while he's still in the process of building that position. But unfortunately, we still don't know which stock it is. So we only know, at least that's what I've heard, that it is a financial company. But besides that, there's a lot of speculation, and it was still not revealed in the most recent 13F. If we now move on and take a look at Michael Burry's portfolio, so the portfolio of Cyan Asset Management, this is a portfolio investors always love to discuss. And before we take a look at the activity here, let me just say that Michael Burry is probably, of all the famous investors, the worst one to clone. And if we just look at the activity in the most recent quarter, this is already confirmed because Michael Burry is just super active. It seems like he's turning over his portfolio, like his entire portfolio in any given quarter. We can see that he's been a buyer of tech companies like Google is a new 5% position for here. Similarly, Amazon also now makes up almost 5% of Cyan Asset Management's portfolio. We also see that he added to his Chinese holdings in Alibaba and JD. Both stocks have performed pretty badly over the more recent month, but also over the last couple of years, actually. And other notable names he added to his portfolio are Citigroup, CVS Health, and Oracle Corporations. Now, another superstar investor whose portfolio activity I like to track is Pat Dorsey because there's a lot of overlap between his and my holdings. And what we can see here is that he was trimming a couple of his big tech names. So he actually reduced Meta by around 18% in Q4, which turned out to be a pretty bad decision because Meta is basically up around 35% compared to the closing price of Q4. He also trimmed Google a little bit, and he also quite significantly trimmed his holding in Wix.com, which is a company I also own. On the other end, he was adding to his position in Herc Holdings and similarly added Danaher to his portfolio, making it almost a 10% position. Now, there are 2 more superstar investors whose portfolios I want to look at. One is Bill Ackman. Here we can see that he has been relatively passive. He was reducing his position in Hilton Worldwide by around 11%. Similarly, his position in Chipotle was also reduced by 13.5%. He almost fully exited his position in Lowe's. And then finally, on the flip side, he was increasing his position in Howard Hughes Holdings. And the last investor I want to look at here is Li Lu. He's basically doing what value investors are best at. He did basically nothing in Q4, neither adding to any of his position nor trimming any of his 6 US securities. Okay, next up I want to briefly talk about interest rates and their impact on the expectations regarding stocks in 2024. So just to provide some context, in the last couple of days, we got the latest reading of the Consumer Price Index, which was released on February 13th, and it showed that the annual inflation rate actually dropped less than expected. It dropped to 3.4% 4% in January year over year. And the core CPI, which basically excludes the more volatile energy and food prices, actually rose by 3.9%, basically at the same pace that we saw in December. So what this is kind of showing, and that's kind of the takeaway here, bringing inflation down may be more challenging than many had expected. Many thought inflation was already defeated, and the numbers show that this may not necessarily be true and that we have to keep interest rates higher for longer. And if we now look at what interest rate traders are expecting and pricing in, this is kind of confirmed. So the likelihood that the Fed will change its federal target rate relatively soon can actually be expressed as a probability. And basically for the first time this year, the market is now pricing in just 4 interest rate cuts in 2024. Previously, just 6 weeks ago, markets were expecting 6 interest rate cuts in 2024. And maybe more importantly, basically the timing of when the first rate cut is expected has been pushed back. While previously many investors expected rate cuts to begin in March 2024, the expected timing of the first rate cut has actually been pushed back to June of 2024. And this is basically expressed in the table that you can see on screen right now. Obviously, you could highlight some other numbers here as well, but I think the ones I just mentioned are the most important ones. So what does all of this mean for investors? Well, if you have watched some of my other videos, you will know that I'm very cautious when it comes to placing too much emphasis on macro numbers, indicators, like for example, interest rates. Obviously, Warren Buffett is right and was right when he was saying that interest rates are to asset prices what gravity is to the apple. It does have an impact on all sorts of asset prices. However, in my investing framework, it doesn't play a significant role. Of course, at the end of the day, the interest rate that you can earn on, for example, US Treasury bonds, that's considered the risk-free rate, meaning that's a rate of return you can earn without exposing yourself to a large amount of risk. Basically, there is very little risk of the US government going bankrupt. However, let's say interest rates right now are around 5%. This doesn't mean that I will be happy with a rate of return of 5% or maybe add a little so-called equity risk premium of 2 to 3% of 8%. No, in my investing framework, I always demand a rate of return of at least 10%, add a margin of safety to that, and I'll often end up with a higher return actually. So pretty much regardless of what the Fed will do and whether they will cut interest rates or whether they will remain stable for many more months, this doesn't affect how I value stocks. Now that's one thought. Another thought I might add here is that obviously interest rates also have an impact on businesses, especially businesses that carry a lot of debt will be influenced by interest rates. However, once again, in my investing framework, I try to focus on businesses that carry very little to no debt, and thus that factor doesn't play a big role for my whole investing process too. And just to wrap it up here, I wanted to show you another chart that I came across on Twitter and that I thought is actually quite interesting. So basically what you can see here are all sorts of dots, and each dot represents the annual return of the S&P 500 index between 1955 and 2023. And towards the left of that graph, you can basically see that vertical line that represents the median interest rate of this time period. And it's around 4%, a little less. And basically the average stock return when the interest rate was below that median was 11.4%, while when the interest rate was above the median, the average return of the S&P 500 was 12.4%, so it was actually higher. And I think this graph here just emphasizes that investors shouldn't place too much emphasis on where interest rates will be in the near term. Focus on individual businesses first, focus on valuing these businesses at appropriate discount rates. So that's the rate of return that you are demanding from your investments. And if you do that and are solely focused on these fundamental aspects, I can promise you will likely do very well, much better than if you would include an interest rate forecasting mechanism into your investing framework. Okay, and then I've got one more chapter. I actually saw another clip on Twitter from CNBC in which Gene Munster, who's a managing partner at Deepwater Asset Management, highlighted that he thinks AI will actually drive the NASDAQ significantly higher. It will double the NASDAQ, or it could double the NASDAQ over the next 2 to 3 years. I wanted to quickly show you that clip, and then I wanted to add my thoughts on it as well.
So I think that it is wise to be mostly in now because, again, I think we're going to this 3 to 5 year bull market. We talked about the negative lever related to inflation, but there is a massive positive lever related to AI. And investors have struggled about how to kind of capture and guess what the impact is going to be. And my sense is that you need to put this on a spectrum of AI and its impact and other paradigm shifts. And I would put the PC at a 20, mobile 25, the internet 50, electricity at 100, a scale 1 to 100. Electricity is at 100. AI is 99. It would be 100 if it not for you need electricity to power AI. So when you have that perspective, when I have that perspective, and I think about what's going on with these interest rates and inflation and where investors are in the near term, I think you can get kind of misled into worrying about what's going to happen over the next 3 to 6 months. And ultimately, if this is as big of a paradigm shift as I think it is, even if it's half as big, I think we could see the NASDAQ move up considerably, 2x in the next 2 to 3 years.
Okay, so just real quick, here's my take. I think AI is the buzzword at the moment. Some stocks, like Nvidia, for example, are driven higher and higher, basically regardless of the underlying development of the business, just because these businesses are supposed to be big beneficiaries of AI. And arguably there's a bubble forming around some stocks just because they are associated with AI. What I will say is that AI will obviously have a real impact on our lives and the profit-making capabilities of many businesses. So just to provide a couple of examples, AI will definitely make the automation and creation of ads easier. It will give lots of smaller companies who maybe don't have a big ad department access to tools that they otherwise wouldn't have been able to access, and which may allow them to create more professional looking ads, which may allow them to target a more specific audience, and so on and so forth. Similarly, another company I have in my portfolio is Wix.com. It's a website builder, and AI will most likely simplify the process of creating a website individually as well. Then we've got Google, and for the first time in over 2 decades, it seems like Google has a real competitor in OpenAI's ChatGPT. So there are many examples you can think of where AI is going to have a real impact on businesses and consumers, and chances are we will see a lot of productivity gains from the emergence and further developments of AI. However, does this mean that the NASDAQ will double over the next 2 to 3 years? I don't think that's a realistic time frame, because you have to understand where the return of stocks actually comes from. So arguably there are 3 main drivers. Either the earnings of the underlying companies go up, the valuation multiple they trade at goes up, or dividends or buybacks add to the return as well. And quite frankly, I don't think AI will actually double the profitability of NASDAQ members, at least not over the next 2 to 3 years. So in order for the NASDAQ to double, the return would have to come from somewhere else. Of course, the valuation multiple could expand, but the NASDAQ is already trading at a relatively high multiple. So I don't think that's a realistic scenario. And obviously, dividends and buybacks, they are not going to contribute that significantly to the return of the NASDAQ. Will the NASDAQ double eventually? I would bet a lot of money on that. However, I don't think it's going to be the case over the next 2 to 3 years. Yeah, and with that being said, I think I'll wrap it up here for today. This video was a little different, me just commenting on a lot of things I came across on Twitter. Let me know whether you like this kind of content or this kind of format, and I'll talk to you in one of my next videos. Take care.